Netflix has just announced a 10-for-1 stock split, and people all over the market are going crazy. But here's the thing. What does that actually mean for you as an investor? Because it's a very misunderstood metric in investing. In this video, we're going to break it all down. What a stock split really is, why companies do it, and then I'm going to put my value on what price I would be interested in buying Netflix stock at. And most importantly, how to think about it like an investor, not like speculating and chasing headlines. Because if you're buying shares just because they look cheaper now because the price is lower, you're missing the entire point of stock splits. Netflix is currently one of the 10 stocks in the S&P 500 with a price above $1,000. So here's what happened. Netflix board approved a 10-for-1 stock split, and here's what that means. Existing shareholders as of November 10th will receive 9 additional shares for each share they currently hold. They're going to get that allotment on November 14th, and the stock will begin trading at the new post-split price on Monday, November 17th. Netflix had split its shares twice in the past, once in 2004 and once in 2015. And here's what Netflix said. They want to reset the market price to a range that'll be more accessible for their employees and make the stock more approachable. And sure, it feels more approachable from when the price tag goes from $1,118 down to $112. But, and this is the part that no one else on YouTube is going to talk about, it doesn't change the value of the business. Now, stock splits are a common tactic for companies that reach these high price levels to split the shares in order to appear like the stock is cheaper. A little anecdote from me. Back in high school, I was in Algebra 2 in my sophomore year. And the teacher was our track coach. Somebody in the class asked him, "Do you own Nike stock?" And he said, "I wish, but I can't afford Nike stock." And I remember back then going, "What do you mean you can't afford it? That doesn't even make sense." He thought because the price of the stock was so high that therefore he couldn't afford it. But that wasn't logical. Stock splits are purely a vain metric, a cosmetic metric to make people think that they're buying more stock, but they're not. What this is like, let's say you have a pizza and it has 8 slices. All a stock split does is takes that pizza cutter, cuts every piece in half again. Now you have 16 slices. Guys, it's still the same pizza size. You're not getting more food. You're just getting smaller pieces. The same thing happens here. You don't suddenly own more Netflix just because the number of shares went up. In fact, guys, if we go to Netflix, in our financials, go to the income statement. As of right now, there are 424 million shares outstanding of Netflix. Guess what's going to happen in 2 weeks? That's going to go to 4.24 billion shares. 10-for-1 split. So, if you own 1 share, you're going to suddenly own 10 shares. Guess what? 1 share of 424 million is the same as 10 shares of 4.24 billion. It's just math. And unless the pie itself grows, your investment hasn't changed one bit. You still have to value Netflix the same way we value every stock, by looking at the difference between price and value. And I'm going to show you how to do that in just a couple of minutes. So first off, let's talk about why Netflix stock has actually done so well over the past couple of years. Netflix made real business changes that actually worked. Let's first start with password sharing. Remember when everyone and their cousin had your Netflix login? Well, Netflix finally said, no mas. In 2023, they launched something called paid sharing. Basically, if you wanted to keep using someone else's account, you had to pay for it. And everyone thought it was going to be a catastrophe for Netflix. But guess what? It worked. Millions of people started paying for their own accounts. You know, it's like, I remember when we had Napster back in 2000, or the other where you could download all this music. And then Apple came out and said, listen, we're going to start charging people $1. It was like, there's no way it's going to work. And it was absolutely successful. Surprisingly, people didn't want to cheat as much as they said they did. Yeah, they did it while they could, but the second it was like, hey, listen, you got to stop, people started paying. Then Netflix was smart. They said, listen, we can charge a lower price. You just got to watch some ads. That tier exploded. By May of 2025, they had over 94 million active users on that plan alone. And here's the best part. The ad money is high margin. When they go out and sell those ads, that's really high margin money. Plus, While the US market slowed down, international growth took off. Places like Latin America and Asia Pacific added millions of new subscribers. And today, they have over 300 million subscribers worldwide. The next up is pricing power. They raised prices in the US, United Kingdom, and France. And guess what? People stuck around. Why? Because the content was so good. They're not just tossing out reruns, guys. They're producing hit shows, original movies, live sports, and big events like Jake Paul versus Mike Tyson, which was kind of a flop in terms of the quality, but they rebounded. People are engaged and they're sticking around to see what Netflix will do next. The bottom line is Netflix went from just chasing subscriber growth to building a smart, diversified, high-margin business. This is a classic case of a company evolving and executing. And when you do that well, the market takes notice. That's why the stock is up. Not because of a split, because the business has gotten better. Now, before we find Netflix fair value and what I determine it to be, let's talk about where Netflix could go from here. Because remember, guys, when you buy a company, when you buy a stock, you're buying a piece of a business. You're not buying the past, you're buying that future stream of cash flow. This is not the same Netflix that mailed you DVDs 20 years ago. Today, they are a global tech and media powerhouse, and they're branching out into multiple new revenue streams. Let's start with the big one I mentioned just a minute ago, advertising. Their ad-supported plan isn't just growing, it's booming. It's bringing in millions of price-sensitive users who don't want to pay full price, and they're okay watching a few ads. Guess what? We all have done that. Most of the people watching this YouTube channel right now, you're going to get ads. That's how people pay their bills. And a lot of people are okay with that. That's a win-win for everybody. And that ad money, it's high margin. It's recurring. And that means Netflix makes more profit on those users compared to regular subscriptions. And it's expected to double again this year. That alone is a game changer for long-term growth. Next, they're getting into live events and sports. Think about this, guys. Netflix is now streaming NFL Christmas Day games, WWE events, boxing matches like they had with Jake Paul and Mike Tyson. These events drive huge engagement, pull in viewers who might not even care about shows and movies, and they're not stopping there. Netflix is also pushing into gaming, even testing cloud gaming on TVs. If they pull this off, they tap it into an entirely new entertainment vertical, and that could be a major growth lever. Imagine not having to buy a console anymore. You just go to Netflix and select the game you want to play. You buy a Netflix controller and you're just playing games. Somebody in the studio just said that would be epic. My response is that will be epic. It is the next step for Netflix. In fact, I wouldn't be surprised if I heard that behind the scenes, Netflix is talking to Microsoft and Sony, the two biggest gaming console creators, and saying, how do we do this? Now, on top of this, they're expanding internationally. Shows from places like Korea, India, Latin America, they are blowing up worldwide. That's not just good content, guys. That's a localized strategy done right, bringing in millions of new subscribers outside the US. On the financial side, Netflix is showing strong operating margins, great free cash flow, and solid pricing power. Let me show you guys what I mean by that. So let's pull up, first off, we're going to pull up their income statement. Look at these financials here. Look at this revenue growth over the last 10 years. 6.8, 8.8, 11.7, 15.8, 20, 25, 29.7, 31, 33.4, 39, trailing 12 months, 43. It is just constantly going up. And the best part is, let's look at their net income. 122 million, just constantly climbing in the billions, in the billions, in the billions, $10.4 billion in the last year. Here's what's impressive. $10.4 billion on $43 billion in revenue is like 23 or 24% margin. In 2015, they did $100 million on $6.8 billion. That's 2% margin. That's huge growth in their margin. Why? Because their gross margin, every dollar they make, every extra unit they sell is a huge profit lever for them. That's a big deal. That means that as time goes on, they are going to make more and more money. They have raised prices in major markets, and guess what people do? They stick around. That tells you subscribers believe the value is there. But let's be real, guys, there are risks. For me, I belong to a ton of streaming services. And the reason being is I just like the variety. My wife and I love watching it, and I'm fortunate enough that I don't really care if something's $8 or $10 a month. Other people out there do care. Guys, I just read an article that Peacock has 41 million subscribers. A year ago, they had 41 million subscribers. I said a while back, years ago, I said, listen, I am worried about Netflix because of the competition out there. Netflix did something awesome. I think they kind of proved they're the leaders and the best. Now, with that said, there are risks. The streaming space is crowded, but could it get less crowded as these other companies realize, like Peacock lost $240 million this last quarter, and that was a big gain from last year. They lost like $450 million in the same quarter. But if you're an investor, you've got to ask, is the business undervalued at today's price? Or is all this growth that's already existed and in the future already priced in? As always, we're here to try to eliminate as much guessing as possible. We're here to buy when the price is obviously below the value. So guys, the real thing about Netflix, in my opinion, is the negative story is execution. Can they sit there and do all these things they're saying to keep their hold in the streaming market? They've shown in the past they are not afraid to make big investments. And for a while there, people thought they were crazy. But when you get people sticky, when you get them to go to your show, listen, we have how many streaming services? The only one I go to scroll through is Netflix. The other ones I only go to when I know what I'm trying to get because somebody said to me, hey, Paul, go watch this show. Hey, go watch this show. My wife and I love watching the morning show. That's the only time we go scroll through Apple TV. So guys, let's now walk through how I analyze a stock and work to find the right intrinsic value, which is the value I think the stock is actually worth. So this is our main page. We have a market cap of $475 billion and an enterprise value of $495. This difference here is essentially their debt. That's $20 billion. Guys, last year they made $9 billion in free cash flow. That means in a little over 2 years, they can pay off all that debt. That is a great thing right there. They have growing returns on capital, 12.4% a year for the last 5 years, 16.9% last year. What does that mean? When they invest money into their business, they get high returns on it. This is the sign of a great business. This is a sign of a business you need to pay a premium for. So remember that for later. They've got 48% gross margin. Remember that number. Every extra dollar they add, 48 cents of it goes to the bottom line before taxes and overhead. That's how you grow this profit margin. 5-year average of 18.9%, last year 24%. Their profit margin's going higher, not just profit. When your profit margin's going higher and your revenue's growing, you have basically this kind of growth on profit. That's also a company you want to pay a premium for. So what does this tell me? Netflix is a premium business, okay? Let's go look at their 8 pillars. Guys, all check marks except for valuation. But remember, the valuation metrics we have on the 8 pillars are based on 5-year numbers. So here's one thing I want to show you guys. Their net income and their free cash flow are 9 and 10.5 billion. So pretty close to each other, but not quite there. Years ago, the thing I didn't like about Netflix, you can go look at our videos in the past. I sat there and said their free cash flow and their net income are like 7x apart. And I was like, oh, I don't like that. Now, probably missed something there. But the point I'm trying to make now is they're much closer, and that's much, much better. The question is, do all these other check marks, return on capital, buying back shares, buying back shares when the price of free cash flow is 53 and the PE is 45 is a little questionable, but everything else is a check. What's the premium you should pay for? Because we agree this is a premium company. I hope you agree with me. And if you don't, by all means, tell me below why. But this is a premium business. It deserves a premium multiple. The question is how much of a multiple? Now, guys, I went through quite a few things here, especially on the key metrics page. I want you to remember that I don't expect you to memorize these off the bat. And there's a lot of metrics I didn't go through. But I want you to realize these are important for us to be able to speak the same language. So I made a very easy and free cheat sheet for you, our key metrics PDF, where I will go explain all of these key metrics and why they matter. If you're interested in downloading that to have it readily available for you, click the link below. In a matter of minutes, you will get access to that PDF. It's absolutely important. Guys, now I want you to remember, I teach on YouTube because I wanted to have I wish I'd had this kind of access and thought process 25 years ago, 30 years ago, when I first started buying stocks and when I was a hype follower and a momentum follower. But nowadays I look at it going, there's a lot of crap out there. I want to make sure I'm teaching a thought out process. But you got to remember, I'm still following the YouTube methods. I still have titles and thumbnails that will say certain things, but in the video, I'm trying to teach something completely different to get you to think like an investor. That is my goal. I want more people thinking like investors. And guess what? You can completely disagree with me on Netflix, but we can still think the same way. That's the interesting part about value investors. I see lots of value investors who disagree on certain companies, but they all do well because they think the same way. Now, let's go see what analyst estimates are on Netflix. Clearly, analysts are bullish here. They have $26.73 per share, earnings per share, growing to $53.28 in the next 3 or 4 years. Now, keep in mind, this is before the split. When this split is done, it'll say 2.67, 3.29, 3.97. You get the idea here. But big time growth in earnings per share and revenue growth, still double digits according to analysts. 15.8, 13, 11, 10.5, 10. That's pretty big, guys. That's really important to realize this company still has growth potential. Now, I want everybody to remember something very important about investors. Most investors lose money because they're trying to pick the next big winner. The best investors do the opposite. They eliminate the losers first. That's what we're trying to do here when we analyze a stock. We're trying to find companies that, one, have staying power, good balance sheets. And we saw with Netflix, they seem to have a very good balance sheet. They have $20 billion essentially in debt with $9 billion in free cash flow. That's easily manageable. But also, and most important, we want to pay a reasonable price for some sort of story. That's the big key here. The story is great, but if you pay too high a price for that story, you're going to have a loser on your hands. Even if the company does very well, you'll pay too much. So how do we put that all together? That's why we have the stock analyzer tool. This is the tool I use to put the story and the numbers together. I'm going to make reasonable assumptions here. And I always tell people, start with the stock analyzer tool. People in our community, I'm always like, guys, start with the stock analyzer tool before you do more research into a company. Because if you fall in love with the story and you don't look at the numbers, then you're going to end up making bad investment decisions. But if you make reasonable assumptions here, low, middle, and high, and let's say the stock here is at 1,100, and I have the value of 100 based on stock analyzer, why do more research? Just stop and say, okay, I'm going to put a notice at $150. Notify me when the stock gets that low. Because why do it? Go find another company that makes more sense. So guys, let's see what I did last time for Netflix. And let's see how much I might change those assumptions today. So first off, I did 6, 10, and 14% revenue growth in the next 10 years. Guys, if they keep gaining on their streaming and they get the games and they get all these other things going, I don't think that's unreasonable. Is 6 low? I think so. Is 14 high? Yeah, but it could happen. The world is growing. The world's they're expanding worldwide. This could happen. So I like these assumptions still. Profit margin. As we see, their profit margin is getting better. I put 18, 22, and 26, and I did the same thing for free cash flow. This is one area where I might change it. I might change this a little bit. Maybe we go with 20, 25, and I'm actually going to 20, 24, and 28. I do think it should go higher because, like I said, that almost 50% gross margin could drive this profit margin much higher. And look what we did here. In the last 10 years, look at their profit margin. 10-year average, 15.5%. 5-year average, 18.9%. 1 year is 24%. So their profit margin is getting better. And over the long period of time, these will equate out free cash flow and profit. And look how much closer it's getting over time. It's getting a lot closer. Now, PE, price of free cash flow. What's an appropriate level in 10 years? Guys, I always tell people the market average is 15 to 16. Start there, go higher for great companies, which Netflix is, go lower for crappy ones. So I put in 18, 22, and 26. I don't know what the right number is here. If you told me 20, 23, and 26, I'd say, yeah, you sound right. If you said to me 14, I'd say that seems low for a great quality business that I think is the leader in a very, very good future business. And then finally, guys, I'm putting my 9% market return. I'm trying to find my intrinsic value. What's the company worth? But remember, you can't buy based on the actual intrinsic value. There's no margin of safety there. If you just want a 9% return, buy a low-cost ETF. And I say this all the time. If you're scared of losing money in the market, I know why. you've probably been guessing. And I used to do the exact same thing. I would buy stocks because someone on TV said that they're going to the moon. But that's not investing. That's rolling the dice. And that's exactly why I built Everything Money. First, it was built for me. I wanted the tools that gave me clarity and helped take the fear out of investing. People saw me using them on YouTube and said, Paul, how do I get that software? And I used to joke and say, you can't, it's a big data feed. But then it dawned on me, no, I can make this for other people. So I did. And a real community of people who agreed to grow together was born. Real people sharing ideas, live chats, live streams, and tools that help you be better than 99% of investors out there. I still use these tools every single day, like Stock Analyzer, Real Estate Calculator, and Retirement Calculator. So stop guessing, start learning, try it for $7 for 7 days, and see how your confidence will replace fear. Click the link on your screen or go to everythingmoney.com. Now, guys, I hit the Analyze button, and based on my assumptions, here's what I got. I got a low price of $4.30, high price of $14.56, and a middle price of $8.04. So guys, based on today's current price, if my middle assumptions occur, I'm gonna get a 5% return on my money based on a discounted cash flow. To me, that says, Paul, you just gotta wait. I have in my watch list at 700. I might wanna increase that to 800. Doesn't mean I'm buying it then, but I just wanna be notified. That way, when it does happen, I imagine the stock will be much better, and therefore I can go analyze it and see a new price. Now remember, guys, after the split, this is automatically gonna adjust to $80 in our software. That's what's key here. Now, let's say you disagree with me, and you say, Paul, I actually love Netflix at this price. There's something I wanna encourage you to look at, an options chain. You can basically get paid to buy Netflix at a cheaper price in the future. So let's pick a month from now, 12/5. What we're gonna do is sell puts. What it allows me to do, let's say I wanna buy Netflix at $1,050. Somebody will pay me $20 to buy Netflix at $1,050. If the stock ends up below $1,050 on December 5th, I get to keep my 20 and I have to buy the stock at $1,050. So I'm basically buying it for $1,030. Imagine that. An ability to buy Netflix at a cheaper price and be paid to do that. Now, guys, earlier this year, I picked 7 stocks to go head to head with the market's Magnificent 7, my own personal Magnificent 7. I want you to click the video on your screen to see which 7 stocks I picked and how they've stacked up. The results this year are amazing. Thank you for your time.